Speaking of keeping score of how things are going, Philip Shaw joins us now, the financial advisor at Goldstone Financial. Hey, Philip, you want to predict the outcome of some games for us today?
Unfortunately, John, I don't have any predictions for you, but it's going to be an exciting day for the city either way with all three teams starting out.
Has the dust settled on this banking thing now as if it never happened, or are there some long-term repercussions here? Is this going to make a difference in my world, Philip?
I don't know about your world specifically, but there are definitely going to be some lingering effects. I'm not concerned that we're going to have further bank failures from here. A lot of what happened was fairly isolated to the couple of banks that had issues. But what it will mean is likely a tightening of lending standards, or in other words, banks are going to be a little more careful about who they're lending money to and how much they're lending.
So what would an example of that be?
Well, for example, Silicon Valley Bank was involved with a lot of startup companies, and a lot of new businesses are always looking for financing for operations. With tighter lending standards, a lot less banks are going to be open to giving those kind of loans, and especially smaller companies, especially startups, are going to have a harder time getting financing and paying for their operations.
And that was the value of an SVB, right? I mean, they were tech-centric. They were willing to take risk. If you want another cool app or gadget, somebody's got to invest money to make that happen. And if a traditional or local bank doesn't feel like they know what's going on in that space, you need a bank that does. That's the void they fill, right?
They absolutely did. Unfortunately, as with any startup, and especially in the tech world, that came with a lot of risk for Silicon Valley Bank. Tech companies in particular are going to have a harder time finding financing now that Silicon Valley Bank is not filling that void in the same way. But because they were filling that void, they took on a lot more risk. That's also why I'm not concerned about a lot of the other banks. They were taking on some pretty specific risk that didn't necessarily play out for them.
Well, I'm thinking of the other types of businesses, too. So I want to open a pizza joint, or my small shop that manufactures tools wants to expand with another 80,000 square feet of shop space. So I'm going to need another $1 million. Those kinds of prospects. Philip, what do you think about that?
Well, that's going to be harder for a couple of reasons. One is the bank may have some additional due diligence they want from you. They really want to know that you're going to be able to pay the loan back. But the second reason it's going to be harder is you have higher interest rates now than you had a year, 2 years ago. If you're taking out a loan and your loan rate just went up by 5 or 6%, that's going to cost you a lot more money. It's going to make that expansion a lot more difficult to handle.
Well, it seems to me like the interest rates, that was all the business of the Fed. Now you're making it sound as though this is the interest of the banks themselves. Is that right?
Well, the one leads into the other. If the banks can basically borrow cheap money from the Fed, they're able to extend cheaper money to the people that they're lending out to as well. As soon as the Fed starts causing higher interest rates, you're going to see higher interest rates across the board.
Yeah.
That's also why you're seeing mortgage rates up from, below 3% to 6.5% today.
We're talking about the markets. We're talking about interest rates. Philip Shaw is the financial advisor at Goldstone Financial Group. And I thought that the silver lining of the bank problems was that it was actually going to pressure interest rates down a little bit. Do you not see it that way, Philip?
No, I agree with you, John. That is actually the long-term outlook of that. In the short term, the Fed still has every intention of keeping rates close to where they are and probably for a longer amount of time than people predicted. But because they're starting to see some cracks in the economy, they may lead to lower rates coming here in the next year, 2-year time range.
When do you think we're going to get to zero or a minus sign?
Oh, to a negative interest rate? My expectation is we still have a ways to go on that, to call it 18 months or so.
Really, 18 months or so?
Until we're actually seeing rates coming back down.
You pointed out to us that there are 100, 200 banks that are struggling right now. I guess the point being that the occasional bank failure is not a four-alarm fire, is it?
No, it's really not. And, prior to 2008, even, there was a lot of bank failures in the early 2000s, and historically these things happen. The 190 banks that are at risk are only at risk if over half of their depositors pull all of their money. So if the banks lost half of their assets, they might have some problems. But that's a pretty unlikely scenario as well.
Well, I'm going to get online and tell all my friends, hey, the bank could fail if we all pull our money out, so let's all pull our money out, and then the bank will fail. It's so cutting off your nose to spite your face, which is what happened at SVB.
Oh, exactly. It's a bit of a self-fulfilling prophecy, where as more people are pulling their money out of the bank, more people are at risk. So the best thing we can do for ourselves is remain calm about it. Most folks are not at a risk at their bank. They have FDIC insurance up to $250,000. And the average person is not keeping more than $250,000 in a single bank.
What do you see for job security? If there is a recession, part of the fallout of that will be some people will lose their jobs. We're already seeing that in some sectors, including tech. What do you see for job security this year?
I don't see a major recession like a 2008 type scenario happening. But where a lot of those job cuts are happening is in the growth areas of the organizations. If they have new projects, they have new initiatives, a lot of people that I know that are being laid off, and what we're seeing in the economy is it's the new developments. It's not the core businesses. So, they're cutting the metaverse division because it's new development. They're not cutting core services and core products.
What do you see about inflation generally, the price of consumer goods?
At this point, I believe, our belief is that inflation has peaked and began to taper off, and we're seeing that in a lot of the data as well. That was more than just a financial issue. There was also a lot of supply chain problems, both here and globally. And especially as COVID restrictions have come up and a lot of these supply chain issues have resolved themselves, we're going to see a lot more return to normalcy come along with that.
Philip, I think a lot of people said $250,000. Who's got $250,000 in a bank? And if you do, then open up another account at another bank. I mean, that's a very manageable and good problem, I think, for a lot of people to have. I think what gets lost in that, though, is that plenty of businesses do need $250,000 plus in the bank, and it's partly how they pay their bills and make their payroll. So what's the strategy for businesses, maybe small and medium-sized businesses, relative to their banking now?
For a lot of smaller businesses, they can keep, even for a small business, you can keep larger amounts spread across numerous banks. It's actually one of the silver linings of the FDIC, which is the FDIC is paid for by the banks, by the way. The FDIC coming back and bailing out Silicon Valley Bank allowed them to continue the startup companies making their payroll, dealing with their operations, having all that happen. It was a big silver lining of what was going on there, the FDIC stepping in. But for the average small to mid-sized company, you can keep $250,000 per bank account spread across numerous banks. And if you need higher cash flow than that, a lot of banks will offer you a line of credit as well.
Do you have any advice for people with their cash right now if they have been sitting on the sidelines watching the market go down? I know I'm asking you to predict the bottom of the market here, but what advice do you have for people who have been sort of waiting for things to turn?
Well, I'm definitely not going to predict the bottom of the market. You got that one right. But, it's something that we're dealing with clients every day is the recommendation always is to keep your planning in mind, to keep your long-term objectives in mind, remain diversified in your investments, and really understand that, the short-term volatility today may not impact your long-term goals and that you're never going to be able to time the market. That said, if you're sitting in cash right now, there's a lot of things you can be doing for yourself, even short-term CDs, treasuries, money market accounts that are paying 4.5%, 5% interest. That's going to be a lot better for you than sitting in a 0% savings account.
So if I take 4 or 5% for 6 months or a year, You think that's a relatively safe bet because you don't think the market's going to improve by 5% over the next 6 months.
I don't know if the market's going to improve by 5% over the next 6 months or not, and I don't think there's anybody that could tell you with certainty one direction or the other. What I'm saying is it's better than sitting in a savings account.
Yeah.
If you're saying, look, you know what, the volatility's bothering me, I'm losing sleep at night, I just don't want to be involved in it, getting a 5% return over the next 6 months is still a pretty safe bet.
Yeah, right. How fortunate for all of us if you say, oh, gee, 6 months from now, I could have been making more than 5%. I hope you're wrong about that because that would be a good scenario for all of us. Philip Shaw is a financial advisor at goldstonefinancialgroup.com. Actually, .co, right, is the website for you guys, or is it .com?
No, goldstonefinancialgroup.com.
Got it. Philip, nice to talk to you. Let's talk again. Thanks for your time today.
Thank you for having me, John.
This is the